Welcome everyone! Thanks for joining another chapter of the Financial Independentist. Today, we're going to talk about Nike's last earnings release, as well as a deep dive on the company's financials. Then, we will discuss whether the company can turn around their current situation with the arrival of the new CEO, Elliott Hill. I will assume everyone here knows about Nike, so little introduction is needed for this global athletic footwear and equipment supplier. But that's precisely their most important asset. Everyone knows Nike, their brand, and their products. Company perception is key for the success of Nike, and that's precisely one of the topics we will be discussing in this video. The company trades at a market cap of around $102 billion, with $46 billion in revenue for the last 12 months, gross margin of 41.9%, and net income margin of 6.2%, so overall we're talking about a pretty large corporation. The stock has been facing a sharp decline from its 2022 highs, when it peaked at around $170 per share, with an average price around $140, to about $70 as of today. That's a $110 per share drop from the peak and about a $70 drop from the average, which is roughly a 60% decline. The company bottomed earlier this year at a little bit over $50 and has been recovering since then. However, it is still far from prior year prices. Investor sentiment seems to be positively changing for Nike in the last part of this year, thanks to the arrival of the new CEO. We will discuss later in this video what strategy he's laying out for Nike in the upcoming years. But before that, let me share a quick reminder that just a few days ago, we published a video with an in-depth analysis of the current situation of Novo Nordisk, the big pharma company manufacturing weight loss drugs like Wegovy and Ozempic. This has been the best performing video of this channel so far, so I recommend you check it out. Link in the description below. And by the way, if you like this content, please make sure to hit the like button and subscribe right now. It really helps the channel grow and you'll even get better content in the future. Please also leave some comments below regarding Nike, whether you own shares and if you're bullish on the company. Alright, let's get started. Nike recently reported its first quarter 2026 earnings result, which were $11.7 billion, up 1%, so basically flat. Nike sells its products to customers using two main distribution channels. First, Nike direct to customers, which represents a bit less than 40% of the total revenue, and second, wholesale, which represents the remainder 60% of the revenue, and has lower margin as it involves third parties in the distribution chain. This quarter, Nike direct revenues were down 4%, while wholesale revenues were up 7%, reflecting a switch in priorities with respect to the distribution channel. As we'll discuss later in the video, this switch is aligned with the new CEO, Elliott Hill vision for the company. Gross margin decreased 320 basis points to 42.2%, also reflecting the impact of the revenue mix, shifting towards wholesale, the lower margin chain. EPS was 49 cents, 30% down year on year, which barely covers the current dividend the company is paying of 40 cents per share. Looking at both the top and the bottom line in the last years, we see that the revenue has been growing consistently, at about an annualized compounded 4%, although with some ups and downs. In the last 12 months, the revenue was $46.4 billion. The gross profit has also been growing a similar way, however at a slower pace than the revenue. This is because of gross margin compression from over 46% back in 2016 to less than 42% as of today. Lower gross margins for a company like Nike means higher material and production cost. This is something management needs to look into. Now, looking at the bottom line, we see that both operating and net income are lower today than they were back in 2016. While operating profit is only $3.4 billion this year, it was $4.5 billion back then. We see that both operating and net margins have substantially deteriorated since then. From a free cash flow perspective, we see wild fluctuations throughout the years, without any clear growth trend. In addition, in the last years, almost all the company's free cash flow has gone to either share buybacks or dividends, limiting the organic growth options. In fact, in this last earnings release, they mentioned the company's commitment to maintain their current shareholder return policy in place, with $6 billion in share buyback authorization remaining for the current plan. Nike has been historically buying back their own shares at a pace of around 1.7% annualized. The company has reduced its number of shares outstanding from 1.74 billion back in 2016 to 1.48 billion as of today. This means one share today represents a 17.6% more of the company's ownership than back then. This is significant, although we see it takes years to materialize. Nike has also been growing the dividend consistently throughout the years, at an annualized of 11% per year, which is impressive, although we see that in the last year there has been somewhat of a slowdown, which anticipates that the next dividend hike, which by the way is due now, is also not going to be that great. In fact, considering that the payout ratio, that is, the amount of the EPS that goes to pay dividends, is over 80%, I don't think they can hike the dividend much more. Just to refresh, this last quarter Nike reported 49 cents of EPS, and they are currently paying 40 cents per quarter. So yeah, there you have it. Nike's dividend yield is around 2.2%, which seems to be around the maximum it has ever been, just behind that large spike we had earlier this year, when the stock price dropped significantly. So to conclude, Nike could be a decent dividend stock if that's what you're looking for, but keep in mind that the next increases are going to be relatively small. Taking a quick look at the share-based compensation impact on the free cash flow, it is still not too significant, although it is worth keeping in mind that while the free cash flow has only increased at a pace of 3.2% annually, the share-based compensation expense has increased at a pace of 12.7% annually. That's 4 times faster. Management needs to look into this as well. Looking into the debt levels, we see that Nike's debt spiked substantially during 2020, the pandemic year, when Nike issued $5.9 billion in corporate bonds and secured another $2 billion from a credit facility. This was management's response when about 90% of Nike's stores were closed, causing major drop on the company's global sales. While the debt has been consistently reducing since then, it has done so very slowly, and as of today the company still has $11 billion in total debt, which compared to the $3.8 billion before the pandemic is still very high. As we discussed before, Nike is dedicating all its free cash flow on share buybacks and dividends, so there is nothing left to repay some of their debt outstanding. As we see, they are paying from 2.375% up to 3.875% on their bonds, which have an associated cost of a bit under $300 million per year. That's about a 10% of their net income, so this is yet another thing management should look into. In late 2024, Nike CEO John Donahoe abruptly retired amid declining sales and was replaced by good old times veteran Elliott Hill. During John Donahoe's tenure, management performance incentives were too skewed to the short term, with specific year-to-year EBIT targets, instead of being focused on the long term. This caused the company to shift away from its traditional product-first culture. Regarding a possible turnaround, Nike's new CEO, Elliott Hill, has indicated in a recent interview that it will take a while. According to him, Nike needs to go through a reorganization period where the company can realign its priorities.
Because you came to turn it around. So what's your diagnosis of what went wrong?
Well, I've tried not to look backwards. I've tried to snap the chalk line and move forward. But if I had to, I think I'm going to oversimplify it. I think when COVID hit, supply got constrained, demand goes up. And I think the team did what I think anybody would do. You shift product over to digital commerce, and all of a sudden that takes off. It's double revenue, double margin, and it's a winning strategy. And then, of course, everything normalized. Physical retail started to open back up, and we continued on with that strategy. And so continue to invest in Nike Direct digital commerce. And I think over time, it ended up hurting the brand because there's a certain set of consumers that want to shop choice, and they want to shop across each of the different channels of distribution. And so
some of the strategies implemented by the previous CEO, John Donahoe, had either become obsolete or were openly damaging the long-term prospects of the company. In particular, during the pandemic, most of Nike stores in the United States, Europe, and other key markets were closed, causing a sharp revenue drop, as we have discussed previously. This forced the company to shift its main distribution channel from wholesale to D2C. While this was a good move from management at that time, as it enabled sales and represented higher margins than wholesale, in the long term it ended up eroding the company's branding mode and ultimately the product quality. Nike's products are essentially physical and highly personal, which means there's a large portion of their potential customers that need to see and touch the product before deciding to buy it. By shifting to D2C, Nike ended up opening retail sales space to other smaller competitors, like On Running, to showcase their higher quality products, further eroding Nike's competitive advantage. According to CEO Elliott Hill, while this was the correct strategy during the pandemic, Nike should have reversed it much earlier as the economy started to open again. Another area of focus by the new CEO was a shift in business segment priorities. Under John Donahoe, the company had focused on mass producing and re-releasing its classic products, like Air Jordan 1 and Dunk, rather than innovating and improving their products. This allowed innovating competitors like On Running to rapidly gain market share from Nike with new and technically superior footwear. Elliott Hill has disclosed that the company has plans to focus on reigniting the innovation, focusing on individual needs that each sport presents, trying to systematically improve their products. This represents a shift away from the previous focus on traditional all-time classics, which had been limiting brand expansion.
Has the competition gotten tougher since the last time you were here and trying to do that?
Oh, no question that the competition is strong today. I think part of it is because we opened up shelf space and open to buy in the wholesale business, and so we're having to earn that back. And we understand the responsibility and what's ahead of us in that wholesale business, but the teams are working hard. And I do believe moving to the sport offense, that sharpness by sport, will not only help us be better with the consumer in terms of product and storytelling, but it will also make us more competitive.
That's the new structure.
That's the new structure. So you become more competitive because if you think about the competition in running, it's very different than the competition in basketball.
Taking a look at the current company valuation, it appears to be fairly valued at this time. EV to sales of 2.3 times seems a little bit above the company's historical average, although it's also true that it is substantially down from the last 5 years average. But again, one can argue it was overvalued back then. Looking at the PE and forward PE, both are around the 37 multiple, which seems to be more than fairly valued for a company like Nike, so it doesn't appear to be cheap either from this perspective. Earlier this year, when the PE dropped to under 20, maybe that could have been the case. But then, when we look at the PE versus price, we see that sure, earlier this year it was cheaper at around $60 per share, so maybe that was a good deal for a company like Nike. Right now, at around $70 per share, I think it is fairly valued, although it's true that the sentiment has reversed from the negative to the positive after the arrival of CEO Elliott Hill. So, what's my game plan with Nike? Well, considering that the sentiment has positively changed after the new CEO arrival, and that a potential turnaround might take years, I think the company is currently fairly valued. We should remember that all Nike does is manufacture a product, then sell the product, and back to manufacture the next product. So it's a one-time monetization instance per product without any recurrent revenue scheme. That's a big limitation to the quality of the company, which only relies in branding mode. It's true that Nike's brand is quite strong, and I have no doubts that they will be around for years and years. But that also makes them vulnerable to brand deterioration risk. If the customers start to feel that Nike is no longer synonymous with top quality and top performance, then Nike as a company will suffer. They need to take better care of their brand, as this is their main asset. So at this time, I don't look at Nike too much as a turnaround company, but rather as a quality cash flow company. But I don't find its business model sufficiently attractive to deploy capital. I think there are better alternatives out there that will overperform Nike in the long term. For these reasons, we have it ranked as a double B company, which is on the average of the investment grade type of companies. But how about you? Do you think Nike is a good company to add to your portfolio? Leave your comment below and we can discuss about it. Alright, that's all for today. Just a quick reminder that this content is not financial advice. Please do let me know in the comment section below if you have Nike stock or you have plans to start in a position. And don't forget to like and subscribe. It helps us a lot in providing better and better content. Thank you very much for watching. See you all in the next episode.